People always say that you have to have money to make money, and that there's an extraordinary level of sacrifice on the road to success. So how is it that investors like us, who didn't start out with much money and who don't rely on banks and credit, how is it that we can increase our income and build our wealth in a way that doesn't require us replacing one full-time job with another while still enjoying the things in life that matter most to us? That has always been the big question, and this podcast reveals the answers. I am Carrie Like, and this is the Investor Warrior.
I love that intro.
Hey guys, welcome to the Investor Warrior podcast. Today, Howie and I are going to be discussing private lending, what it is, who does private lending, why would someone want to do a private loan on real estate? Now, we work with mostly private lenders at this point, but at one point in our journey, we used a hard money lender.
At one point.
Because we had to, because we didn't have any credibility. We hadn't done deals yet.
We didn't know what we were doing.
But it's an interesting story because people always ask me, well, how do you build up a private lender network? And the answer is, well, you start doing deals. You start getting out there, start doing deals, and you start talking to people. This is a relationship business, and private lenders specifically, very close relationship that we have with our private lenders. In fact, we just went out to lunch with one of our private lenders the other day and caught up with them. This isn't someone who you just call randomly. I don't know you. I have a deal. I need money, right? This is not what that is. Right. But if I can just share the story with how the very first private lending experience that we had, I talk with my hands. I've been pushing my hands down. Are the flip that we did in Georgia. I think it was one of our first flips.
Yeah.
We did a hard money loan.
Right.
Yeah. It was actually a hard money loan. We had money into it and we borrowed some money from a friend.
And it was one of the biggest renovations we've ever done.
It was, yeah.
So as a first time.
It was a tough renovation.
Ridiculous.
And so we had a couple different ways that we pieced it together so that we could fund it. And I went to a hard money lender because I didn't have any credibility. I hadn't done any deals. I didn't have any private lenders in my network. And I think we paid like 14% interest, really high interest rates. They dinged us every time, they came out to inspect the property because there was a draw schedule with the lender. That's right. It was a very expensive loan, but it's okay because it funded the deal. Hard money, what's the saying? It's easy to get, but hard to pay back because it's expensive. But sometimes if you're first starting out, that's what you got to start with. And so that was the case with us. And we were in a coaching program at the time, and I was talking about this deal all the time because it was one of our active current deals. And there was a group of people on the call. And when we finished the property and we sold it, it was a big win for us. We went and celebrated. And on the next call, we had gotten another deal under contract, and I started talking about that contract to the people on the call. And I had already reached out to the hard money lender. I was going to line up the funds. Hard money lender was really excited to work with us because we had taken out the loan. We had paid it off. Yeah. Now we're ready to do another loan with them. Yeah. And I was on this real estate coaching call talking about the next deal that we had under contract that we were going to do. We were going to line up the hard money lender again. And someone from that call reached out to me directly and said, hey, you did such a great job on that last deal. I heard that you have another deal under contract. Do you need some money for it? And I was like, well, yeah, I always need money. Right? I'm not going to turn down money. I said, well, yeah, I have a hard money lender that we used on the first deal, and I was going to use it on the second deal. And this person said, well, I can probably give you much better terms if you want to do a loan with me, because I would be interested in loaning to you, right? Because I had built up credibility. I had had a relationship with this person. We had a little bit of experience under our belt with the hard money lender. And now someone had reached out saying, hey, I want to lend on this one.
Can we kind of unpack this for a second?
Sure.
So I think one of the key things that I'm hearing you talk about right now that's sticking out, but you're glossing over it really quickly, is that you were exposed to a community.
Yes.
right? In this case, through coaching,
Yes.
right?
Yeah.
So being exposed to a community where people are hearing what you're doing
It's
is
really important.
really, really important.
Yeah.
And so what kinds of different community, I mean, you don't have to go be in a coaching program,
Mhm.
but what kinds of communities can you be involved in, number one? And number two, what are the actions that you can take to make sure people are hearing you?
Yeah. Are you asking me?
Yeah,
or?
yeah.
Okay. Or is this a hypothetical question?
It's
getting out there and talking
the
to
lesson.
people, right? It's getting out there and talking to people about what you are doing.
Mhm.
Okay. It's going to the county meetings, the city meetings, the networking events. It doesn't always have to be real estate. And we're going to get to the who, because private lenders can come in all kinds of shapes and forms and places and sizes and
colors.
Yeah. I mean, there's no one size fits all here with a private lender. It's not like there's a Google search. I'm looking for a private lender. Hard money lenders, yes.
Yeah,
Private lenders are that. It's private individuals. It's people who have money in IRA accounts or self-directed 401k accounts or savings accounts or HELOCs or, there's all different ways this money can come to a person, but now they have it and now they want to invest it in a secure a loan. And we're going to talk about that.
Okay.
So how do you start talking to people? You just start getting out there and talking to people about what you're doing. And if you have a project, that's great. Start talking to people about the project, about how you had someone fund it. It might be a hard money lender. That's fine. And once you start to build up that experience, you can start to build a credibility kit. This is also where it's really, partnering with people in the beginning can be really, really beneficial in the beginning, because we partnered with people.
I know, but we don't that much anymore.
On our first deal, we didn't partner with anyone on that deal. We did it on our own. But sometimes I've had people partner with us on a deal where they had never done a renovation before. And all of a sudden, right after the renovation, they were like, hey, can I use this project as a deal for someone I'm going to be talking to with private lending? And I'm like, absolutely, because that was your deal. Even though, let's say they were only a 10% partner in the deal because they just, maybe they just brought us the lead and we negotiated it and got it under contract and funded it. And let's say they were only a very small percentage of the deal, maybe 5 to 10%. They were still a partner in that deal, and they can use that deal in their credibility package when they're talking to private lenders. Here's one that I just did.
I think the reason I started making faces is because we tend to overuse the word partner.
I agree with that.
And partner in the business world has a very, very specific. I'm not going to go down that route. It has a very, very specific definition. No, but it's good.
But I'm glad you brought that up.
It's good. It's good to air this out. Okay.
Yes.
And so having partners in a practical sense, not a legal sense, I think is what I'm saying, on a specific deal where everybody kind of has their role and things like that. Yeah, definitely can do that. I will say also, but be careful, tread lightly. Actually, we should do a whole show on partnering.
It's giving us good ideas.
Because it is kind of the devil and the angel at the same time. So
that would be a really good show to do.
I did want to take you back though, because we talk about needing private lending and needing some credibility. Okay. And our story is one.
Yeah, that's
it was one.
Well, I was talking about it all the time, though.
Right.
I was talking. It was like my world. It was our world for a little while. It was like that renovation ran my world for a little while.
That was the first lesson. That was the first lesson. We talked about that a moment ago. But for those of you that are worried about credibility, that are worried about, oh my God, do I have to have a portfolio of deals and things like that? Right. I mean, you're living proof that it's not necessarily, right?
You don't necessarily.
If you combine the two, you got your first deal, you're working it hard, you get yourself into communities. I'm getting out of the camera. If you get yourself into communities that are interested in this stuff and they're hearing your journey, right? People love the journey. Yeah. And you talked about the good and the bad and everything in between when you were talking about
absolutely.
What was it?
Castleton. I don't know what the name was. That was a long time ago. I can't believe I remember that address.
Oh, how could you not?
I know. It's a memory that
right. It was crazy.
Unstuck from my mind ever.
It was a crazy deal. So it wasn't perfect by any stretch of the imagination, right?
No, it wasn't.
Without getting into that story.
In fact, when I was on that real estate coaching call, most of the time I was talking about all the challenges and the problems that we were running into. And I honestly think I had built up so much credibility with people because we worked through those challenges and we worked through those problems, and we ended up selling the house and making a profit on it. And it wasn't easy, But people saw that we were dedicated, that we were problem solvers, that we were hardworking, that we were determined, we were persistent, and we were already on to the next deal. It was like, okay, that was a hard one. Let's try this easier next time, right?
So I just want to recap the lesson.
Yes.
You don't have to have a big portfolio.
Nope.
And it didn't have to be perfect.
Nope. In fact, you can have these conversations with people before you even do a deal, as long as you understand what private lending is. If you can have a conversation with someone on what it is and understand it, then you can start to build up private lenders in your network who say, yeah, when you get a deal, I'm interested in lending on it. So this is what we're going to go with, go through today.
Fantastic.
Let's talk about who. We talked about who could be a private lender. Anyone can be a private lender. Well, except if you're like 7 years old, like our son, he can't private. Well, can you lend?
Custodial counts, yeah, absolutely.
Who can lend? Let me tell you a story about the house that we owned in Newport, Rhode Island. Okay. So my family owned a house in Newport, Rhode Island. They were having some challenges with it. We decided to buy into it a few years after they purchased it. Right. And one of the problems they were running into was they did this modification on the loan. It was a traditional loan with a traditional bank, conventional loan. And this was during the crazy years. I think they bought it in 2004. And then the crazy years of 2008, they went into this program, this loan modification program. Right. But all of a sudden, when the loan modification came due, and all of a sudden it reverted back to this original loan, it put them in like this negative cash flow situation. It just wasn't a good loan.
Yeah, exactly.
And so that's when we entered into the scene. And one of the things I said was, well, why don't we wipe this loan out with a private loan? We could.
To which your family said, what's a private loan?
Right. Well, what does that mean?
Loan? Yeah, what does that mean?
And I said, well, is there anyone in our family who has some cash lying around that wants to invest it into a piece of real estate, i.e. this piece of real estate, so that we can wipe out this traditional conventional loan with the bank that wasn't working for the deal anymore. And now we can replace it with a private loan. And so what happened was my grandmother, who has now since passed away, she had money just sitting in her savings account and it wasn't doing anything. And she was at
0.002.
Right. I mean, maybe it was doing something, but not enough to like make it count.
Yeah.
And she didn't want to put it into the stock market because at her age, she didn't want that kind of risk.
Yeah.
This was money that my parents were eventually going to inherit anyways. And my parents owned the house. And so I said, well, why don't we wipe out this loan with grandma's funds? We give her an interest rate. So now instead
of a fair interest rate.
Now she gave us a pretty good deal on the interest rate because it was grandma.
But it was like
she went
10x what she was getting.
Exactly. And so now all of a sudden, instead of that money sitting in her account doing nothing, she was getting interest payments that were creating income for her. And then when she passed away, that note my parents inherited because it was their money that they were going to inherit anyways. And so what it allowed us to do was to keep the property, because at one point they were thinking, I think they were thinking about selling it
and taking a hit.
And it just wasn't going to be a good scenario. And what we did was we turned a bad scenario into a good scenario by wiping out that loan with a private lender. And it was from a family member.
Well, and let me recap the benefits. It turned an upside down cash flow situation right side up. Yep. There's a lot of other details to it, but
sure, in that particular deal,
Carrie stepped in with her, experience and was able to get the family together and say, okay, here's the 5 things we're going to do, and we're going to get this place performing. And
it benefited a lot of people. If you think about it, the bank got paid off.
Yeah.
Okay. Grandma got a monthly income stream
that she didn't have before,
with a loan that was secured by real estate. My parents got to put themselves into a positive cash flow situation. We bought into the house, and as
part of this restructuring,
as part of the restructuring. And then eventually, when Grandma passed away, we structured this so that someone inherited that note.
Right.
And that's going to be important
Yeah.
when you're dealing with older people who want to lend on real estate. And let's say they're lending long term. Well, what happens when they pass away? And that can all get transacted with the paperwork that we do
Correct.
with remainder beneficiaries. So
Right.
my parents in this case were a remainder beneficiary, which meant they inherited the monthly income stream.
Note, yeah. And we're not lawyers, so you always check with your lawyers on this. But the key phrase there is remainder beneficiaries.
Yeah.
Yeah.
So, okay. So what is private lending? Private lending is a private loan. It means you're not going to a bank. You're not going to an institution.
A professional bank. Or
you're
money
going
lender.
to a person.
Yeah,
It's a person who has money that they want to invest in real estate, but they might not want to be active in real estate, meaning they don't want to find the deals. They don't want to manage anything.
Yep.
They don't want to own the real estate. They just want to invest in the deal as a passive investor. Right. And they want their money to be secured by an asset. Maybe they want to take some of their money out of the stock market because they're sick of losing money in the stock market. I don't know. But they want a safe investment.
Mm-hmm.
Okay. So this could be grandma, mom, dad, friends, family. This could even be sellers. We have worked with people who we bought the property from them. Now, all of a sudden, they have money in their bank account that they didn't have before. Mm-hmm. And now they're like, well, what do I do with this money?
Yeah.
Now we say, okay, you've just converted a seller. We've cashed out the seller. And now they could be a private lender for you.
Absolutely. Mm-hmm. That's why, this is another show. The relationship with your sellers is so important.
Absolutely. Absolutely. So that is the...
Who?
Oh, I'm sorry. Were we on the what? I lost track.
You're doing okay. No, we went to who.
We did? Okay. So that's who. Okay. Let's go into the what.
Yeah.
Oh, we were on the what. What is the private lender? Yeah. Okay. So benefits of private lending. Okay. Private loan has two different things involved when it comes to paperwork. Now, this depends on what state you're in. Let's just stick here with Florida.
Okay.
We are
As an example, Florida example.
We're a mortgage state
versus
a deed of trust state.
And the basic difference between the two is?
Well, they're both security instruments.
Right. They're both how you secure the loan against the property. So they're collateral instruments.
Yeah, they're both security instruments to secure the loan against the asset. Yes. But they operate differently. I don't want to go too far into this. We were just talking about this the other day.
5 words, yeah.
Actually, because we just made we just did an offer. Made an offer on a state that is a deed of trust state.
No, it's both.
Oh, it is both.
Yeah,
you're
both,
right.
And that's what got
it's
us
in Montana, and it was deed of trust and mortgage. They use both. And so I was talking to the realtor about this, and I was explaining, or we were discussing the differences between a mortgage state and deed of trust state. Yep. With a mortgage, it's a judicial process to foreclose, so it can be much longer.
There you go.
Longer process.
Yep.
So in that scenario, the lender, they do take on
differences, but that's one of the basic ones, right? Okay. So I just wanted to make that clear.
Okay.
So we're a mortgage state.
We are a mortgage
in Florida.
State. Yeah. Okay. So in Florida, we're going to have a mortgage, which is basically the security instrument that secures the loan with the asset, which is real property, which means if we default on the loan is backed with the asset, which means the lender can take the asset back, go ahead and sell the asset and get their money back.
Yeah, it's theirs now.
Correct.
Yeah.
And then you have the promissory note, which spells out all the terms of the transaction, the loan. Yep. Okay, that's the interest rate, when payments are due. Is this interest only, or is it an amortized loan? What happens if there is default? What happens with late payments? So many things can go into the promissory note, right? That's like
all your terms.
That's where you get creative. And this is the thing that I love about working with private lenders is this is where we get together with a private lender and we create a loan transaction that's going to work for us and that's going to work for them.
Everything's negotiable.
Everything is negotiable.
Try doing
you
that
can get creative. You can get very creative with things.
Can you do this with a
promissory
traditional bank?
No, you can't go into a bank and say, listen, I need this interest rate. I need this term. I need, it's like
it's their way or the highway.
They need, and if that doesn't work for you, go find someone else.
That's right.
Not the case with a private lender. Okay. This is us sitting down over a cup of coffee and saying, okay, does this work for you?
Yep.
This works for us.
Yep.
How can we make this better?
Mm-hmm.
How can we address this question that you have,
yep.
et cetera, et cetera.
So that's one of the first benefits.
Correct. So it's secured by real property.
Right.
Mm-hmm.
So you have a hard security versus the stock market.
Right.
Which tends to, or can kind of go to zero.
Yes.
Right. Real estate doesn't have a history of going to zero.
No.
Yeah.
Well,
it can back up, but it
doesn't
typically go to zero.
We're also, the way that we're purchasing these properties, the loans that we are doing with our private lenders have a great loan to value.
Yes, it's a good point.
Okay.
Yeah.
So what does that mean? It means that the loan is down here, the value of the property is up here, and they have less risk. Okay. Because if the value fluctuates, they're still covered with their loan with the value. Does that make sense?
Yes.
Okay. So they have loan to values where they might be at 70% loan to value. Okay.
Right.
And that's going to decrease their risk.
That makes them feel more secure.
Correct.
Because even if the real estate backs up a little bit in terms of its value, they still have room in there to be secure.
Correct. So let's say we buy a house for $100,000.
Right.
Let's say there's a crash in the market.
Right.
And let's say the value of that house drops to $80,000.
Right.
But we did a loan with them for $70,000. So their loan is still 100% backed by the value of the asset.
Exactly. Got it.
Yes.
Okay.
Insurance. Let's talk about property insurance, because this is a question I get a lot. How does property insurance work when I'm lending on a piece of property that you own?
It's something I think about the least too.
Really?
It's important. Yeah.
Okay. But it is important. So as a requirement for the loan, we take out property insurance, just like you have to when you go to a bank. The bank is going to require that you always have property insurance because they want to make sure that their collateral is protected.
Right, in case of a fire.
If a fire burns the house down and there's no insurance, well, then what happens to their loan? The collateral that secures the loan has collapsed.
To the value of the land.
Correct. Yeah. So what we do is we take out a insurance policy, whether it be a vacant insurance policy, if it's a vacant house, or we might take out a hazard and liability insurance if we're putting a tenant in there, and it's going to at least cover the loan amount, if not more. And we make them a primary insured on the insurance policy so that if the house burns down, they are the first people that get paid.
And it's important that you as the investor, as the one that's putting this deal together and going to the lender and having these conversations, that you're driving these conversations.
Sure.
You're showing them that your proactive investment in theirs is secure.
Okay. I hope we have okay internet because it keeps going in and out. So they're going to be primary loss payee on the insurance policy.
Primary loss payee.
Which means if something happens, they're the first one to get paid.
Okay.
Okay. Okay. So let's talk about the mortgage payment itself. If they're lending on a piece of property where we're going to keep it long term, the way that we're going to make sure that we are protected as well as they are protected is that the cash flow covers the mortgage payment in most situations. So they don't have to worry about us running out of reserves, running out of capital, because if they're lending on a piece of property that we're holding long term, we are creating this loan so that the rental income or the cash flow from the property is at least covering the mortgage payment.
So it's not just the loan to value, it's also the cash flow is
ratio.
Sufficient to cover their note.
Correct.
The taxes, the insurance, and that everything's okay there.
Correct.
Okay.
Now you can do long-term loans or short-term loans as a private lender.
Sure.
In fact, we have a handful of private lenders. Some like long-term, some like short-term,
Mhm.
some like to be just a lender where they don't own any piece of that property. Some like we used to do equity partnerships with them where they actually did own the property and they were lending on it. And instead of getting a monthly mortgage payment, they were getting a piece of equity.
This is part of the
So there's
flexibility of working
all
with a
different
lender.
kinds of loans that you can do. So there's long-term and short-term. So usually long-term is going to be, I'm talking with my hands again.
Yeah,
Sorry.
you put your hands in your face. This is two different things.
So long-term is usually going to be anywhere from, 5 to 30 years. Short-term could be a 1 year. Right. So a year, if we're buying, okay.
Right.
So that is just fundamental basics of what a private loan is.
Okay.
Do you have any questions?
No, you want to do a recap?
Gosh, I wish I had my notes. I was making notes. All right.
So first thing, I'll tell you what I remember.
Okay.
I'll tell you what I remember. First thing,
Yeah.
you don't have to have a huge portfolio
Sure.
to attract private lending.
Yes.
Right. Second thing, even if you've only done one deal,
Mm-hmm.
it doesn't have to have been perfect.
Yes.
Right. Second thing, what is a private lending? So private lending is money from individuals or small groups of
Mhm.
individuals that are not professional lending institutions
Correct.
and aren't hard money lenders. Hard money lenders tend to be professional lending institutions.
Yeah. Well, and there's some people
Mhm.
who lend privately. It's an individual, but they are experts now at private lending, and they lend out to a lot of different people, and they've formed a company around private lending, and they act a little bit like hard money lenders.
Right.
Yeah.
So another thing that I remember
Mhm.
that was key in this conversation was how to get your voice out there, right? Get out there in the community, get active. I think that's a really big key, because if nobody knows who you are and we're sitting in our little holes, here in our office and doing our thing with the computer and calling contractors and all of that kind of stuff,
Sure.
who's going to know about it?
Start taking people out to lunch. Start taking people out for coffee.
Or bike rides.
I don't want to do this on a bike ride. How are you going to have that kind of conversation?
Shared experience. We'll have another show on shared experiences.
Golf courses, great ways to have these conversations.
Shared experiences,
But start to surround yourself with people who might have money laying around that might want to invest.
Right.
And if you have to start with family and friends, that's where you start.
Right. Right. And then what else? As we moved into the what, we talked about the what.
We talked about the who.
So who is anybody who's not a private,
and who
a professional
is
lending?
really money. People who have money in self-directed IRAs, self-directed 401ks, savings accounts, checking accounts. We've had people who pulled money out of a HELOC.
Right.
And, they might be paying a certain interest rate on the HELOC, but they can get a higher interest rate by lending it out. And so they basically make a spread between the interest rates. We can have people like grandma who have a savings account and it's not doing anything.
Right.
Or people who are they don't want the risk of the stock market anymore and they want to pull their money out.
Yep. So then we talked about how private lenders assess a deal from a risk standpoint, right?
Yes.
So the two things are loan to value, right? So typically they're lending somewhere between 70%.
Around 70% loan to value.
And the key thing we didn't talk about is it's not always current value. It
Correct.
can be what's called ARV.
Yes.
Okay. So a quick on ARV.
I'm glad you brought this up because that's one thing that we didn't discuss is a lot of times when we're purchasing properties where we can force the appreciation up by making improvements to the property.
So rehabs.
But even rentals, because a lot of times we'll buy rentals where maybe they're not at market rent, it needs repairs. So we're putting the improvements into the property and we're increasing the rent, which is increasing the value of the property. And so many times when we work with our private lenders,
almost always,
that's true. Almost always, we are going into a deal with an exit strategy of improving
Right.
the property.
So the loan
which puts
here,
their loan
yeah.
to value in even better situation.
Right. So the conversation with them isn't that I'm buying the house for 100,000.
Mm-hmm.
It's I'm buying the house for 100,000. I'm going to put 50,000 into it, and then it's going to be worth 200,000.
Yeah.
And all of the information that goes along with that, so everybody can see that that's the case.
Mm-hmm.
Then the loan to value, a lot of times at that point, is 70% of the 200,000, not 70% of the 100,000, and that is a big distinction between the two. And so another power of the private lending, you won't get that so much with institutional lending. A little bit, but you kind of get construction loans to perms, and it gets complicated and all that kind of stuff. But just that to me is a huge factor and a huge benefit of working with private money. So
okay. The other thing that we talked about was cash flow. If we're holding on to this property long term, we're going to make sure that the cash flow we get out of the property is equal to or greater than the mortgage payment. It's funny, as I said that, I was thinking to our son's math equation with the alligators. I'm like, wait, which way is the alligator going? Is it greater than? Remember the alligator? Like the alligator wants to eat the greater number.
I come from a sheltered area.
We were just working on that. Greater than or equal to. That means the alligator is eating the greater number. I don't know why I don't know nothing about alligators. Anywho,
I hate alligators.
Anywho, just something that I remember
They're
from homework with our 10-year-old or 9-year-old.
Okay.
So getting back to.
Can I recap it?
Yes.
So obviously you need the cash flow to be sufficient, equal to or greater than the amount that you have to pay out to the private lender.
If this is a long-term loan,
plus your taxes, insurance, and maintenance budget.
Yes.
Okay. Which is normal.
Yes. Yeah. Now, if this is a short-term loan, there's so many ways that, again, you can handle the mortgage payments. A lot of times, because we've worked with our private lenders for so long and we have great relationships with them, the interest is on the back end of the loan. So it's an accrued interest, meaning we don't make any mortgage payments while we're renovating the house. They get paid all of their interest when we close on the property.
Can I try to clarify that?
It's accrued interest on the loan.
But the accrual starts the day we take the money.
Absolutely. Okay, so the accrual starts when the money goes into our account and we close on the property. They have the mortgage, they have a note, but we're not making any mortgage payments out to them because everything is accruing on the back end of the note, on the back end of the loan. So when we go to sell that property, they get paid all of their interest.
So they get the principal back and plus the interest that has been accruing. Correct. Which when you're rehabbing a house is huge because you don't have to service that loan during that.
Correct.
Try doing that with an institutional bank. That's another example.
But again, in the beginning, when we were just starting out, we were having to make mortgage payments. We had to build that credibility and relationship with people.
But we also didn't learn. There's a little bit of we could have probably, if we were as experienced as we are now, and what we're sharing with you guys, we could have negotiated that early on and gotten away, and not not gotten away with it. It's a horrible way to put it, and actually come to agreement on that with many more lenders in the early days. We just didn't know how. We had to learn that kind of like as we went along. So we're sharing that with you.
Yeah. Okay. So we also talked about the insurance, how every time we work with a private lender who is lending on a real piece of property, we're going to take out an insurance policy to protect that real piece of property in the event of damage or catastrophe. And so what it does is it protects the lender as well, not just the property, but and us. It protects the lender as well. And that actually just reminded me of one other thing that we didn't talk about, and that is when we close on a property, we always get title insurance on the we get title insurance from our title agent. When we're working with our private lenders, we also pay for a lender's title policy. So it actually protects the lender too against the title. So that's really important because that's something that they receive at closing. And again, it just protects their loan.
And the key thing about this too is a lot of the lenders you work with won't know about any of this stuff. And so you're the one that's actually bringing it to them because you have a huge interest in protecting their interests. And That's how you build great relationships. That's how you get people to want to give you money in the future.
Yeah.
I mean, honestly, we have more money thrown at us than we have projects to do them.
Yeah, sometimes. Another thing, now I'm thinking of other things that I just want to mention too. We did a podcast recording with Andrea Hosh on land trusts. And most of our properties are purchased into a land trust, which you cannot do with most traditional lenders, conventional lenders. They will not allow you to purchase a property with a land trust. A lot of times you'll have to purchase it in your company name and then place it into a land trust. It can get really difficult with non-private lenders, but with private lenders, we purchase the property into a land trust that protects, and you can probably go back to the podcast
go back to that podcast,
with Andrea. But what it does is it also gives further protection to both us and the lender. For instance, if something were to happen, we were to get a code enforcement lien on one of our properties. If the current property that's being lended on is in a land trust, that means a code enforcement lien from one of our other properties can't attach to this one, which means it's protecting their collateral.
Right. Their other assets.
So we're not going to get into all the benefits of land trust because there's a lot more in there, and you can go back to the podcast with Andrea Hosh. It was a great podcast. So, okay. We also talked about you can do long-term loans, you can do short-term loans, you can do equity participation, you can just do straight loans with people, you can do interest only, you can do amortized, right? Creativity here is infinity and beyond.
Yeah. Limitless.
Buzz Lightyear, infinity and beyond, right? With the way that you can put these loans together. And this is what I love about it, is because you're sitting down with your private lender, discussing what it is that they're currently getting on their money, what it is that they would like to get. Would they like to own a piece of this property? Would they like to just be a completely passive lender? What kind of interest rate? What's going to make them happy? What's going to work for us? It's like putting all the pieces of the puzzle together to form a beautiful puzzle.
Together.
Yes. And so you can get really, really into these transactions to make it work for everyone.
Awesome.
Did we cover everything? I think that was pretty much it.
So do we like private lending?
So we pretty much only operate with private lenders at this point. There are still times where we will go to traditional lenders.
Very few.
But a lot of times at this point, we're working with our private lenders, both in short-term and long-term loans on both single family and multifamily and commercial. In fact, some of our sellers that we have, when we've purchased the property from a homeowner and they have cash in their bank account, we've worked with them to put that money to use into a private loan. So it's just so many great things with private lending. I mean, we could like go on and on and on and on and on about private lending.
But it'll keep coming up, right?
Correct. Yeah. All right. Anything else? Did we cover everything?
I'm happy.
Okay. Well, as long as you're happy, then I'm happy.
That's all that matters.
Happy husband, happy life.
What was that backwards?
All right, you guys. Hope that was helpful. If you have any questions, you can contact me at Carrie@theinvestorwarrior.com, or you can message us here on Facebook, LinkedIn, YouTube, wherever you're watching this live stream. And we will see you on the next show. Take care. And remember, you're only one deal away.